Hello and welcome to Options in Plain English Advanced Edition. Today we're going to be talking about the effect of the hard to borrow status on options. What we're going to do is we're going to start taking a look at this stock that is apparently been in the news and that apparently has been in everybody's watch list as of late. The company is Nikola Corporation and the ticker symbol is NKLA. So it's a company. I don't know too much about the company, but I just know the basics, which is that it's a company that's going to be manufacturing and designing and bringing to market something that's similar to Tesla. So basically, a sort of an electric car, but I think they're going to be focusing on trucks, electric trucks. So that's all I know, and I don't need to know anymore. We're just going to be analyzing what happens when we have a parabolic move such as this one, which has happened over the last few weeks, and what the consequences of these moves are, and what usually happens to the options, because some traders are really surprised about what's happening to the calls and puts for this company and for any company which is undergoing something like this. So basically, let's start by just looking at the stock very quickly, and we're not going to analyze the price, what happened, why that happened. We don't care about that. We care about the options, but let's try to focus on this company and see what we can gather from just looking at the price chart. So Nikola Corporation has 360 million shares outstanding, so that's the whole company. The float, or the floating shares, are 198 million, and today's volume was 21 million. What that means is that it's 1/10 of all available shares were traded today. So it means that it's basically the flavor of the month. Everybody's trading it, and the price moves are exaggerated because there's not a lot of shares available. That's why the jumps have been so big here. You can take a look at this candlestick, for example. On this day, it went from $40 to $73. So it's been very volatile, and this is what's been happening. It started going higher from a price level that was around the $12 mark, and it started going higher, and right now it's trading at 64, but it actually traded at almost $94. So it's been a parabolic move. Sometimes these things happen. It happened to Beyond Meat not too long ago, and it also happened to several other companies in the past. So something that you're likely to encounter as you're trading, especially if you focus on not on ETFs but on individual companies. So continuing on with this, when the stock started going higher, what happens is a lot of traders and hedge funds and basically anyone who is able to look at this company and realize that it's just an idea company, because they don't have a product yet. They just have an idea to bring this product to market, but they don't have any revenue yet. So a lot of traders are trying to sell those shares short, so that they can benefit from some stabilization in the price and from a drop in price in the stock price. Since there's not a lot of shares altogether, and when you want to short a stock, you need to do a locate on that stock, and you have to borrow it from someone who is going to be giving you the permission to take it and sell it in the market. When these moves happen, there's not a lot of stock available. What happens is the stock enters into a status called hard to borrow or none to borrow. What that means is that when you want to short a stock, usually what happens is you locate the stock, you borrow it, and then you sell it, and maybe you pay some shorting fees, or maybe you get paid a short rebate. But in any case, those fees are never very high. In these cases, when the stock is hard to borrow or not to borrow, the shorting fees, the stock borrowing fees are very high, and that has an impact on the pricing of the options. We were talking about a stock borrowing fee and the or also known as a short selling fee. And in this case, for example, for Nikola shares, if you want to short Nikola Corporation, the stock, you have to pay an annualized rate of 770%. What this means is if you borrow, let's say, $100,000 worth of stock, just to hold it, let's assume that probably that rate is not going to last very long, but assuming that it would stay for a very long time, for a year at least, that means that if you want to short $100,000 worth of Nikola Corporation stock, you're gonna have to pay 770%. So you would be paying $770,000 in short selling fees. Okay, so it's very expensive to short. Okay, so it's not a matter of just saying I want to short the stock and that's it. No, you have to pay for it on top of the regular commissions and transaction fees that you have to pay to short a stock. Now, as you probably know, when you are long a stock, you're not exposed to unlimited losses. But when you short a stock, you're exposed. This company could double, triple, quadruple from here. We don't know. And you're exposed to losses, okay? So if you want to take a shot to the downside, then you're going to have to pay the annualized rate that is a part of the short selling fee or the stock borrowing fee. By the way, I got this information from a very useful website. I'm not affiliated to it, but I just use it a lot, and it's not a website but where you can go and do business, but it's just like an informational, but it's very interesting. The website is called iborrowdesk.com, and what it tells you is it tells you for a certain stock what the rates for borrowing the stock or for the short selling fees for that stock. This is where I got this information from. Okay, now let's take a look at the options, which is what actually it's important to us. So we have Nikola Corporation. It's trading at $64. Okay, so the first thing we notice is that it has a status of hard to borrow, and we knew that because I already looked it up. So the short selling fees are an annualized rate of 770%. Okay, so we know that it's hard to borrow, or maybe none to borrow. Maybe they haven't updated it yet. Okay, here's the volume, 21 million shares, and they don't pay a dividend. Well, they don't even have a product. How can they pay a dividend? But that's beside the point. The first thing that we can notice here, and what I've done is I've opened the July 2020, so 30 days to expiration. See what the options are doing, how they're priced. And the first thing we notice is we go to the at the money, which is the 65, right? Because it's trading at 64, and you expect the price of the call to be somewhat similar, not identical, but somewhat similar in the same range as the price of the put. Well, in this case, that's not the case at all. The call is trading around $7, and the put is trading at $30 to $32. So big difference. Okay, so right away when you look at this, you notice that there's something weird about this. And what we're gonna do now is we're gonna try to explain and try to understand why this happens, and more importantly, what you could do and what you should not do with situations like these, because they appear to be very tempting. They're really tantalizing. You look at them and you see free money just lying there, and it's not that simple. So let's try to understand why we have this discrepancy. Okay, so the first thing we're going to do is we're going to try to find a logical approach. So just conceptually, why do you think the puts are so much more expensive than the calls? And if you think about it, the only way for you to go short this stock, or the simplest way to go short this stock, since it's very hard to borrow and it's very expensive, the only way to do it is to buy a put. That's why puts are expensive, because that's where the buying pressure is, because you can't short the stock. You can go long. That's why the calls are not that expensive, but you can't go short. That's why whoever wants to take a shot to the downside has to do it by using puts. Okay. Now, the second explanation for this is a little bit more convoluted, but bear with me, and it's actually straightforward, even though it's a little bit convoluted. Okay. So when you we know that it takes 770% annual rate to short the stock. Okay, you can still do some locates, so you can still short it. It's hard to borrow. It's not none to borrow, so it's just very expensive. So what happens is, let's say for example you want to buy this put. Okay, so if you go to the market and you buy a put, whoever it's so the counterpart, your counterpart is many times, more often than not, your counterpart is going to be a liquidity provider or a market maker. So it's not going to be directly another trader. It's going to be, like I said, most likely a liquidity provider, or if it hits the exchange, a market maker. So the market maker, what they do is they provide liquidity, and the liquidity provider as well, obviously. But the important thing here is when you buy the put from them, they have to sell you the put. So their book is now bullish, is now positive, has positive deltas. So they need to hedge with short stock, and that hedge is very expensive because shorting stock is very expensive. This is the reason why the puts are so much more expensive than the calls. Okay, so just logically, the only way to short right now is by buying puts. That's why they're very expensive. Now, the second explanation, let's talk about put call parity conceptually. Okay, so conceptually, when we talk about put call parity, the explanation in our heads is that the stock is equal to long a call, short a put, minus the interest rate plus the dividends. Dividends don't play a role here, so just forget about dividends. But let's focus on interest rates. Why is this factor here? Well, it represents several things, but basically it represents the money that you would get if you get cash and you park it somewhere. This is the money that you can get with no risk. It's the risk-free interest rate. Now, when you short a stock, you get the money, and then the idea here, or the way the formula works, is you take that money, you put it somewhere, it starts earning interest, and it's accruing all the interest that amount can give you over the time of that investment. Now, when you short, that's what happens usually when you short. Okay, you take the money, you put it somewhere, it starts earning interest. Now, I'm not going to go into the details that usually your brokerage firm, as part of your agreement and as part of in order for them to give you very low commissions or very low transaction fees, they're the ones who are benefiting from it. It doesn't matter. From a global perspective, someone is taking that money and putting it somewhere, earning the risk-free interest rate. Okay, so in this case though, when you short, yes, you do get the money and you can put it somewhere, but you have to pay for that as well, for that short position. So instead of earning money, let's say, for example, you're earning, I don't know what the risk-free interest rate right now is, but let's say, for example, it's 1%. Okay. Yes, you are making 1% a year. That's your interest rate, but you're paying 770% a year. So you're actually not receiving money. You are actually paying out money. Because of this, the interest rate here is a negative interest rate. Okay, so that's why this interest rate is going to be a little bit different, because it's going to be negative. Now, a negative interest rate is going to have a positive sign here, right? And it's going to, something that has the positive sign in this put call parity conceptual approach is a dividend. So the if you think about it, and this is stretching it a bit, but if you think about the negative interest rate, which is the short selling fee, as a kind of a dividend, you know that dividends pull the call prices down and push the put prices up. So that's what happens to the prices of the call and the prices of the puts. Now, if you solve for the put and you take it from here, move it over here, you'll have this formula that the put is equal to long call, short stock, minus the interest rates plus the dividend. Dividends don't matter, so just ignore them, okay? So this number, this interest rate number, instead of it being a negative, is going to be a huge positive number, because these charges or these fees are going to be, these shorting fees are going to be included here, okay? So now the interest rate is going to be the risk-free interest rate, what you make when you have cash, minus the short selling rate, which is what you have to pay out when you short. Okay, so this is going to go here and is going to make this put be call minus stock plus a big number, because it's minus a big negative number, so it's going to be a big number here, and this is where the dividends are going to go, which don't matter at this point. Okay, so that's why the put is inflated here, because because of the short selling fees that you have to pay to short the stock, and everything is related. So that's why options, if you see these numbers, your first reaction would be probably want to do something like a reversal, where you short a stock and then you're long the synthetic, so you would be buying a call and selling a put, because the selling the put is really juicy right here, right? Because it's really fat. And the truth is that when you short, when you do the portion of the reversal where you short the stock, you're going to be paying a hefty fee to just maintain the short. So after you do all the calculations and you analyze your cash flow, you're going to be left with a wash, pretty much. Okay, so finally, if we look at a third approach, would be the put call parity formula. So same as here, but now we're going to use the formula. Okay, so what the put call parity formula tells us, and we've already had a lesson about this, so if you would like to do so, you can check it out. It was one of the advanced lessons. And here what it says is the stock price, and then multiplied by e to the minus qt, which is basically being how the dividends affect the stock price, is equal to the strike price, and then the effect of the interest rate plus the cost of the call minus the cost of the put. Okay, so we know that the dividends don't play a role here, so it's going to be just the s, but the minus r here, look what was going to happen. We have the k. Okay, now usually when you have an interest rate, that k is going to be pulled a little bit lower, so it's going to be pulled lower in price, such that a high interest rate is going to make this strike price go lower, which means that this equivalent strike price is going to make the calls be more expensive and the puts be cheaper, obviously, because it's if you have the call for this one and you compare it to the call for the 60, for example, if we're comparing here the 65 and the 60, well, the call for the 60 is bigger than the 65, right? And the put for the 60 is, of course, lower than the 65. Okay, so in this case, it's the opposite. You actually, instead of it going minus RT, instead of discounting it based on the interest rate, it's actually going to push it higher. So the effective strike price is going to be over here, which means that this put is equivalent to the put that you would have in a risk neutral world if you were looking at this strike price. So you are adding all of this in the put value because this strike price is going to be pushed higher by the R, which now includes not only the risk-free interest rate, but a negative short selling rate that you have to pay in order to short the stock. So what are the takeaways now that we know more or less why things are like this? Well, you have to be careful with something that looks too good to be true with the so-called free money trades. For example, conversions and reversals, because what's going to happen is, if you take a look here, the extrinsic value for the calls, especially for the in-the-money calls, see how small it is? What that means is when you start combining it, if you think of putting on a box spread or a conversion or a reversal or a vertical, these short calls are going to be at risk of early exercise, big risk. Why? Because the extrinsic is almost negligible, and whoever is long the call is better off, of course, exercising, getting the stock. You're going to have to be short the stock. You're going to have to pay those shorting fees, and the other party, the other side of the trade, is now going to have stock which he or she, this trader, is going to be able to lend this this stock out for it to be shorted, earning this huge short selling fees. Okay, so if you have the stock, you can lend it out, and then you get the 770%, for example. So bottom line is, if you have short calls, especially in the money calls, and you put on a position that you think it's a lock, for example, a conversion, a reversal, a box spread, long box, short box, you think that it's locked and you just have to wait and collect your money because maybe you're buying a $20 box and you're paying, I don't know, $15. So you just have to wait and collect the money. Well, that's not the case, because right away your box is going to be broken by someone exercising your in the money call. And now you're going to have short stock. You don't have a short call anymore, and it becomes very problematic. So be careful with these kinds of strategies, okay? Verticals as well. One of the things that we were having this morning, for example, was that some of the short in the money call spreads, so for example, let's say the 2025, which is already in the money, okay? That spread was trading for, let's say, $5.50. So it's $5 wide. So you have some free money because you can only lose $5, right? So you put it on and that's it. And it's just wait for it to expire and enjoy the money. Well, that's not the way it works, because as soon as you put it on, someone's going to exercise your call. And now you don't have a vertical spread anymore. You're going to have a short stock position plus a long call, okay? And on your short stock, you're gonna have to pay the stock borrowing fees, and that's what's going to throw your numbers off. In reality, when you see some arbitrage opportunity, the most likely thing to be happening in that particular case is that you're not considering something that's going to throw your numbers off, okay? So I just wanted to take a moment and look at this, which I thought it was an interesting case, an interesting case study. So now we looked at Nikola Corporation, and now you know why, more or less, these numbers look so out of so weird. So the why the puts are so overpriced, and why the calls look so cheap in comparison. Now, if you think about, for example, okay, I don't want to deal with the calls because they're going to be obviously they're going to be exercised early, so I'm going to be assigned early. But what about the puts? Well, the puts are a little bit safer. Okay, you're going to be put you're not going to be put a stock, and if you do, for example, let's say for example you sell a put. Okay, let's say you sell the 50 put. What's going to happen is, yeah, this is juicy right here, right? So the actual break even if you sell the 50 is 32, and the 32 is, the delta is 12%, something like that. Let's say 11%. Okay, so you have an 89% probability of profit, which is pretty good, and you're receiving a pretty big credit, because for this one, even if it's cash covered, and it has to be cash covered for this one, it's only $5,000, because it's 50 times 100, so it's $5,000 to make 1,800. That's not bad. Okay, you put down 5,000 to make 1,800. That's not bad, and it's a good break even. And if you are concerned about, here's where your risk would be, is if you put it on and then you wait for it to go down, it's not going to go down, because remember, now this price is tied to the short selling fees. Okay, so as long as those short selling fees are the same, these puts are going to remain elevated. Now, if you're short a put and the price goes higher, then yes, of course, you're going to profit. But don't think that all of a sudden this $50 put is going to go down to $8 just because they pass or something. No, because this is related to the short selling fees. Okay. Now, what about early exercise? Well, what if you're assigned early? Okay, on this, for example, let's say you sold the 50 put. Well, if you sold the 50 put and you're assigned early, the other party is pretty much leaving the extrinsic value on the table. Okay, because it's out of the money. The whole value of this put is extrinsic value, and they would be foregoing that money, and that'd be a windfall for you. At that point, you would be, yes, long the stock at a price of 50 minus 18. It's going to be at 32. So now that's going to be your new position. You're buying stock at 32. Now you're going to be having the risks associated with long stock. And if you're okay with it, and you believe that Nikola Corporation is going to make it and is going to probably start going higher, then that's a good risk to have, maybe. Okay, so from the point of view of the options and the option mechanics, the puts are safer than the calls, because the puts are inflated. Okay, and and if for whatever reason the short selling fees start going down, then these are going to start going down, and you're going to profit as well. So selling puts a little bit safer than selling any type of call, especially in the money call. Okay, so I hope that this kind of clears the air a little bit, and as to what's going on with companies that are hard to borrow or none to borrow, and how this is reflected in their options. Thank you very much, and goodbye.